Yeah, thank you. And thanks for joining us today. Just to start off with a disclaimer that's really been at the start of many webinars we do that's covering new retirement related bills. And that's that some of these bills are massive. This one in particular is over 4,000 pages long. Fun fact, I think it's the second longest bill ever to be passed by Congress. And so we can't possibly cover everything in a relatively short webinar here. Just what we aim to do is highlight a few parts of this bill that impact the majority of people and discuss some planning opportunities around those changes. And then you'll also see we have a couple slides at the end that will more quickly summarize some changes that you maybe just apply to fewer people, but could be very significant for them in particular. And for those, we just want to highlight these changes as a way to let you know about the change. And we'll talk in a lot more detail during the meeting about how those changes specifically impact you. But the part of the bill that has the biggest impact for our clients is a change in the RMD, or required minimum distribution ages. Just as a reminder, this is the age when you're required to begin making withdrawals from your pre-tax retirement accounts like IRAs, 401ks, 403bs, etc. And first, know that if you're currently taking RMDs, there is no change. You'll continue to be required. You'll stay on that same schedule. Secure Act 2's rules on RMDs do not impact anyone already taking RMDs. But if you're not taking RMDs, then you are affected by this change. And just to try to put it most simply, if you were born between 1951 and 1959, your RMD age is kicked back 1 year from where it was previously to age 73. And if you were born in 1960 or later, your RMD age is now 75. And so it's either a bump back of 1 year or 3 years, depending on when you were born. And remember, this has changed now a couple times. RMD ages changed from 70 and a half to 72 just a few years ago with the original Secure Act. Now it's being bumped back even further. And this change also means that no one starts RMDs this year in 2023. And so if we're just kind of wondering how this impacts you at the very least, you're not starting RMDs this year. No one does. And so what does the delaying of RMDs mean for your financial plan? It still means that topics that we've talked with you about, like withdrawal strategies and Roth conversions, are still going to be incredibly valuable, especially if you have a significant portion of your retirement in those tax-deferred pre-tax accounts. Although they bump back the starting age of RMDs, the percent of your account that you're required to take out each year stays the same. That percentage that your RMD is based off of comes from what the IRS calls this uniform lifetime table that's shown here. And this has not changed at all. And so maybe just said another way, the amount that you previously had to take out at age 72 is not the amount that you now have to take out at 73 or 75. The amount you'll need to take out when your RMDs start is going to be higher. And so when RMDs start for you, it will be a bigger amount than you will have to take out than you would have had to take out at age 72. And so the beginning of RMDs is delayed. A lot of people like that, but it really does nothing to help retirees from eventually seeing those really high tax rates that can be caused by RMDs later in retirement. And in fact, this delay could make things worse if you do nothing, because the assets now will continue to grow for a couple extra years. That's a couple extra years of building up additional tax liability in these accounts. And so if rising RMDs were going to be a problem for you from a tax perspective, they still will be, even with this. The new RMD change buys you additional time to get money over into Roth accounts or just spend it earlier on in retirement, though. And so how this impacts you specifically is just going to depend on your situation, of course, but it may result in smaller annual Roth conversions, but maybe for a couple extra years, just for example. What we're trying to do is take advantage of a period of lower income that retirees typically have between the time they retire and then when Social Security or RMDs begin. We tried to show that in a chart here that we use a lot just to try to identify low tax opportunities, when to do Roth conversions, when to accelerate withdrawals. And now this period of potentially lower income is just longer, again, to age 73 or potentially 75, just depending on your age. And it also gives retirees just a few extra years to use that pre-tax money to pay for withdrawals or regular living expenses over time. For those that maybe had smaller Roth conversion plans, this might mean that just a modified withdrawal strategy is all that's needed now. Maybe you don't have to get into an aggressive Roth conversion plan. But if you do wait until your mid-70s, especially before you start thinking about Roth conversions, this change might mean doing even more conversions since RMDs now have the potential to get bigger if you don't act earlier on in retirement. And so moving on to another big change that was in this bill, and this is the allowance to transfer money from a 529 college savings account into a Roth IRA beginning in 2024. First of all, there's a lot of fine print to this that we're going to cover in the next few slides. But if you do everything right, there's now the ability to transfer up to $35,000 per individual in their lifetime from a 529 account to your Roth IRA. And so again, that's a lifetime limit of $35,000 per person. And you can do this transfer regardless of your income. You might know that there's an income limit to be able to contribute to a Roth. Just for example, for 2023, that's $153,000 for single filers or $228,000 for married couples. If your income's above that, you're not able to do a full Roth IRA contribution. This transfer can be done regardless of your income, so potentially a big benefit for higher income households there. But here's the fine print to be able to take advantage of this. And like I said, there is definitely some fine print. So first of all, the 529 must have been opened for at least 15 years before you do the transfer to a Roth IRA. So for those of you that have old 529s open, this might be something you can take advantage of soon. If not, this might be much more of a long-term planning strategy. Next, none of the amount that you can roll over from a 529 to a Roth can be contributions or earnings from those contributions that were made in the last 5 years. And so again, even if you have an old 529 still open, but there isn't much of a balance, there's a 5-year hold on any contributions before they can come out and moved into that Roth. Next, the owner of the Roth IRA must be the beneficiary of the 529. And so most 529s are set up with the parent or the grandparent as the owner, and then the child or the grandchild as the beneficiary. That means that the money can only go into the child or grandchild's Roth IRA. And the asterisk is here because one of the benefits of 529s has always been that you can very easily change the beneficiary of the account to certain family members without any tax impact. And for example, if I have a 529 account for my son or with my son as the beneficiary, but he doesn't need the money, I can change the beneficiary to many people, including myself. What's not clear in this bill is if changing the beneficiary impacts that 15-year clock. The IRS is just going to have to offer guidance on that. And that potentially has a big impact on planning here, either making it much easier or much harder to execute this. Then any amount you roll over from a 529 counts towards the annual Roth IRA contribution limit. And so just for example, in 2024, when this opens up, if the annual Roth IRA contribution limit is $6,500. The most you can transfer from a 529 to a Roth IRA in that year would be $6,500. So while there is that $35,000 lifetime limit, you have to do that in pieces, and it's subject to that annual limit. And then lastly, the owner of the Roth IRA must have income to qualify them for a Roth IRA contribution to do this transfer. And so, I think a lot of people are seeing this as an opportunity, maybe to jumpstart like a grandchild's retirement savings quick. So if you set this up now and in 15 years you want to make the transfer, if that 15-year-old isn't working and doesn't have income, you're not allowed to do that transfer. They must have earned income to qualify for a Roth IRA contribution and qualify for this transfer. And so I think this last bullet point here is the one that we're really going to have to plan around and just make sure that since we're planning here 15 years out, you're still going to be eligible for a Roth IRA contribution to take advantage of this. And so just maybe as a summary here, there was lots of fine print there. It's a potentially valuable benefit, but there's a lot of kind of hoops to jump through to make sure you qualify. But, if you do, what are the opportunities that this opens up? I think three main options. One is saving for yourself. With enough planning, it will allow just about everyone to effectively be able to save more money in your Roth IRA, which in general is one of the best accounts to save for retirement, we think. Again, since there's that long 15-year waiting period that has to be met, this could be a long-term strategy for some. But for those with extra cash flow in their 30s, 40s, or even 50s, and particularly if you have high income, this is something definitely to take advantage of, as it can be an extra $70,000 that a couple could get into their Roth IRAs. And that's very advantageous for younger households in particular. And what this was really meant to address, I think, was the concern that parents have about saving too much money into 529s, or their kids not ending up needing the money, not going to college, getting a scholarship, something like that. We tend to not find this as big of an issue as a lot of people make it out to be, but this is now another out that you have with this 529 money that can hopefully give you the comfort, the confidence to save into a 529 if paying for a kid or grandchild's college cost is a goal of yours. And then lastly, this can just be a great way to help kids and grandkids start their retirement savings or just boost it by a little bit. If your plan's in good shape, this is a good way to effectively just get a little more inheritance into a tax-advantaged account for your heirs. On to the next topic, there's a big increase in catch-up contributions that you can make into employer retirement accounts. This is a bit strange and only available for a select few, but so just as a reminder to start, beginning at age 50, you can contribute more to your 401k or 403b workplace retirement plans. For 2023, the amount that anyone can do is $22,500. And then if you're age 50 or older, you're allowed to do an extra $7,500. Now, beginning in 2025, there will be an even higher catch-up amount, but it's only available if you're age 60, 61, 62, or 63. And so if you're between those ages, your new catch-up amount, again, beginning in 2025, will be 150% of that normal catch-up amount. And so if this was going into effect this year, just for example, that 150% means that your new catch-up amount is now $11,250 instead of the $7,500. And this seems a bit strange compared to what we're used to, because your savings amount then is going to drop back down once you're age 64. But I guess that's just the way it's going to work from now on. And so your early 60s are now really the prime years to put more money into your retirement plan if you're able to. But potentially the bigger change with catch-up contributions now is that there's going to be a requirement for some that any catch-up contributions must go into Roth portion of your 401k. And being able to save more into a 401k is always a good thing, but potential tax impacts for some. And so starting next year, if your prior year taxable income with just your current employer were in excess of $145,000, all of your catch-up contributions must be made to the Roth account. You will not be able to save those catch-up contributions into a pre-tax account like you can now and get that tax deduction. So your regular $22,500 can still be pre-tax, but the additional $7,500 or $11,250 will have to be Roth. And this won't be a bad thing for a lot of people. Roth savings are really great to have. But for a few that are at very high levels of income late in their careers, or really want a lot of tax deductions for one reason or another, we'll look into that here on the next slide, then you might not like this change because it's going to force you to be taxed on that income, when in the past you'd have the chance for, up to like a $30,000 deduction. And so one aspect of this that I think is interesting is that if your current employer 401k does not have a Roth option, this makes it so that no one in the company then can do catch-up contributions. And I think the impact of this is just going to be every employer is going to eventually get a Roth 401k option, because otherwise they're really risking having highly compensated employees being pretty upset. And then last note on this change is that the income of your spouse does not matter at all for this. It's solely based on individual income, which is a little unique as far as tax rules go. And so this could, again, create some interesting strategies for households where one spouse has high income, in excess of $145,000, and the other spouse is below that limit. And so the specifics of this change add some tax planning opportunities for those who are age 49 and up. There could be some potential benefits to changing up saving strategies in order to get under that $145,000 limit. And that's because that $145,000 limit is taxable income. So just for example, if you have $175,000 in gross wages, but you max out your health savings account, you pay for health insurance, you max out your 401k with pre-tax contributions, now your taxable income is under $145,000, and you're able to do catch up now in pre-tax income with pre-tax income next year. And so this won't come into play for everyone, but for those it does, it's going to be a really valuable planning opportunity. And just for example, on the right of this slide here, we showed a few common tax credits or deductions or surcharges that exist based on your income. And these income limits shown here are for a married couple, but different limits exist if you're a single filer as well. And so if you're age 49 or over with a salary between $145,000 and about $180,000, and you take advantage of any of these opportunities here, doing some planning around this change is going to be really important. All right, let's see, moving on here, one more Roth-related change. Beginning now, or really once your employer updates their plan documents, you may elect your employer match to be made into a Roth account. Previously, this was always a pre-tax contribution. That's not going to be the case anymore. And so what that means is that if you elect your company match to go into your Roth account, that will get added to your taxable income. So if you have a salary of $100,000 and your company does a 6% match, your new taxable income is going to be $106,000. But this isn't mandatory, unlike that last change. So this is really just a great option to know that's out there. And it's a great option for those who Roth savings just really make sense. And the increase in taxable income is not a big deal. Another change with employer matching, and that's beginning in 2024, you may elect your employer match to be made towards student loans. For some, this will be a good benefit, effectively letting you use pre-tax income to pay your student loans. This might be of value in particular for high-income households, but I think those considering this should just be careful that this is also potentially a big decrease in your retirement savings. And generalizing here a bit, but I think this primarily impacts younger savers, just getting into the workforce with their student loans still. And at that age, getting money into your 401k early is really pivotal to start taking advantage of, compound interest down the road. And especially for those with federal student loans, there's just a lot of great protection on those loans, like income-based repayment plans, loan forgiveness options, that might make it not a good idea to sacrifice retirement savings in order to pay down these loans faster. And so this is an option. It will be a good option for some, but I don't think it's an option that should just universally be elected by default and deserves some discussion and planning first. All right, there's a number of new options for penalty-free withdrawals from 401ks. So this is for those under age 59 and a half. I won't go into the details here because there's a few different types of withdrawals that are allowed. In general, these target early or entry-level employees, I think, who might be afraid to really save into their 401k because they want to build up that emergency fund. They're worried about needing that money. There's new options for either $1,000 or $2,500 penalty-free withdrawals for cases of emergency. And that definition of emergency has been very relaxed. So just about anything can qualify now. And then another option that impacts those a little bit closer to retirement is that 401ks can now be used to pay up to $2,500 per year for long-term care insurance. And that's withdrawals that can come out penalty-free. As a reminder, that withdrawal is still taxed, but if you are 58 and paying for long-term care insurance, for example, you can now use that 401k to make that payment, or at least up to $2,500 of it, and not worry about the early withdrawal penalties that would normally apply. So this is potentially beneficial for the right person. We just also see a majority of people look for long-term care insurance after age 59 and a half. And at that age, you're allowed to withdraw from these accounts penalty-free anyway. So it might not be a huge impact to everyone, but is beneficial for those that want to pick up long-term care insurance a little earlier on in your plan. And then last topic here, and one that we're really just wanting to mention so that you know that if this applies to you, it's worth looking into more details on, because there are a lot of changes around business owners and business retirement plans. In general, new Roth options are now available for just about every type of retirement plan, like Simples and SEPs that didn't have it before. And there's also an entirely new account called a starter 401k. This is an account that has no company match, essentially just acts as an IRA for your employees, but it might be useful for small businesses that just have a few highly compensated employees and you don't want to have a bigger retirement plan for some reason. If you have a solo 401k or individual 401k, you now have more time to make your contributions. It used to be by December 31st, you had to make your personal contributions by. Now you have until the tax deadline. So this just gives those with individual 401ks a pretty good tax advantage, or pretty good advantage when tax planning, and potentially a big change for those. And then lastly, just know that if you're a small business and looking to start up a retirement plan, there's new tax credits available where the IRS could essentially pay for plan startup costs, which hopefully would help nudge your business in the right direction if this is something you're considering. And then last slide here, but I just thought it might be good to list a few items that did not change with respect to this bill, because this bill, the original text for Secure Act 2, has been circulating for a couple of years. There's just never really been momentum to pass it. This kind of end of year spending bill that had to happen was a opportunity, I guess, for this bill to get tacked on. And so there was a lot of press in the last couple of years about big changes to some items that just didn't make it through to the final draft of this bill. And so just for example, there are no changes to backdoor Roth contributions. This is a way that those with higher income can sometimes get money into a Roth IRA. There was a lot of talk about this going away, but it's not now, or it's not in this bill. Same with Roth conversions. There were prior versions of this bill that were going to severely limit who can do a Roth conversion just based on income or account balance, and nothing along that line made it in. So just about anyone's eligible to do a Roth conversion now. And there was some text in prior versions that were going to create extra large RMDs for those with pre-tax retirement accounts over certain balances. This was going to be potentially a huge deal for those with, large 401ks or IRAs. Nothing like that made it through. So once again, no changes there. And so thank you for attending again. This was not an exhaustive list by any means. There are other topics and changes that tend to just apply to maybe a niche, number of people, just a select few. And as you can see, it took long enough just to cover some of these bigger changes. But if there are other aspects of this bill that impact you, we'll be in touch. You'll hear from us this spring or fall on our planning meetings. But hopefully this helped just kind of put some of those headlines you might have seen about this bill into perspective. So if you have any questions, please feel free to ask. Otherwise, thank you and have a great weekend.